Dan Ives of Wedbush Securities says this AI boom could become even bigger than the internet revolution, and he believes 2026 could be a major turning point for tech stocks and artificial intelligence. In this video, I'm going to show you the clip from Dan Ives's interview, break down exactly what he meant, and give you my own reaction and analysis of his bullish AI predictions. Then, I'll reveal 3 brilliant growth stocks that could benefit massively from this revolution. Let's hear what Dan Ives had to say.
Thank you so much for joining us today, Dan. We've had so many earnings crossing, there's still more to come. Cisco later this week already at a record. When we hear from Michael Burry, it suggests that investors are wrong-footed, that they're racing into one space. But the argument has been that there's so much uncertainty with geopolitics, AI demand is hot, investors want to be exposed to that, a little bit like we saw post-financial crisis with the FANG stocks. What's your perception as you see the earnings and the reality of the performance?
Look, I think these earnings has validated the AI bullish thesis. And we saw it last month when we were in Asia. Demand to supply is 10-to-1 for chips. I mean, we are in the early days still of the AI revolution. I think, look, the haters will hate, and we know that. But we're going to be talking about tech stocks for the coming year, because I think we're going to Nasdaq 30,000 as this all plays out, given where I see now it spreads the second, third, fourth derivatives.
Well, to that derivative and where you should be playing this, investors have gone right back to the semiconductors now. They've looked at the issue that is in memory capacity with some of the chip makers, but they're also looking at the high-end AI side as well. So what do you make of whether that is the right space to be exposed, or would you go a little bit further away from that stack?
Yeah, look, I think it's a memory supercycle. So when it comes to SK, when it comes to Micro and Sand, I mean, we're very bullish in terms of what we're seeing there. And that's not going to end anytime soon. But we talk about in our Ives AI 30, it's about playing the hyperscalers. Of course, chips. Then you have to play software, cybersecurity, some of the infrastructure, power, names like GE Vernova, IREN, and others. I think that speaks to my view. You can't just own one subsector. You have to own the derivative plays. And I continue thinking this AI party started at 9:30 p.m. It's now about 11:30 p.m., goes to 4 a.m. And now look, like Intel, they're on the dance floor. I mean, others are going to continue to participate in it.
Yeah, it's fascinating what has happened with Intel, but I want to just pick up on your point around moving further out down the line, because the apocalypse moment for SaaS has been at the back of everybody's mind still. They're concerned about it. And I was talking to VCs that saying, look, they spend the whole time talking about the moat. They're really concerned that companies they've invested in as well, that have just bringing in these amazing revenue numbers, could at some point not. How do you navigate from the winners and losers when it feels as though that winner could be tomorrow's loser instantly?
It's a great question. Look, and I talk about it's almost like an AI ghost trade in terms of Anthropic, the words it's going to essentially structurally break the software sector. Look, I think you have to separate for winners and losers who has the moats. I think ServiceNow is a good example, way overdone. Like, I think that's a good example of one, the stack that they're going to build. They're going to be able to ultimately monetize the AI revolution. I think Salesforce is another example. And then look, Adobe, backs against the wall. They're going to need to really, whether it's acquisitions, maybe strategic, more focus, they're going to have to show it. So I think investors are painting it all with the same brush. But when you look at, say, cybersecurity, CrowdStrike, Palo Alto, I think those are two golden opportunities that is actually just going to get bigger based on what we see with AI.
I hear you, Dan, and I'm so repetitive, and I'll come at it from exactly the same point as ever, because I think the viewers always love the same conversation sometimes. Is kind of almost a shortish answer, if I can, for this one. Is Nvidia still the best company out there making chips for AI going forward?
Yeah, and you always make great points in terms of like everything that we're seeing right now with AI. There's only one godfather of AI, and then that's Jensen. And it just speaks to everything starts, the hearts and the lungs of AI is Nvidia.
Great. Thank you for keeping that one short, because this brings me to the point I wanted to make. If Nvidia is still the godfather, the best out there as well, which I thoroughly believe is the case, and you've already mentioned Intel, why do I have to pay 4 times the price for Intel that I do for Nvidia, when Nvidia is the standout fantastic company?
You're preaching to the choir. I mean, I agree 100%. That's why I think Nvidia is one where, even though look, AMD, I think Lisa Su, everything, that is one now finally starting to get validated. When I look at Intel, that's one look, it's had a huge run. I think they are well positioned relative, but But every day I'd rather own Nvidia over Intel.
But isn't that taking away from, it kind of just says to me, people are scattergunning, spraying money at it, and they don't care about the valuation, they care about the momentum, which is great while it lasts. But then you've got this has happened, and Nvidia's done well recently, but it's gone out, whereas Intel's done this kind of thing. And then that just says to me that actually one of these days it's going to go like that.
Look, I think part of what's happened, it's all about second, third, fourth derivatives. And investors are trying to figure out, okay, let's take an Nvidia. Like, you look at it, and obviously that's been the historic trade. Now, is it Intel? Do you own AMD? Do you play the memory supercycle that's playing out? And then look, you could, as this goes, there will be areas of froth, and we talk about it, but I think that's why as an investor, you have to separate for who are the winners, what are the valuations that they could grow into. That's been a whole argument, let's say, in a Palantir, right? There have been many haters. They hate it when it's in junior high school at $12, $13. They despise it when it's $140. I believe that's going to a $1 trillion market cap in the next 2 or 3 years, but they have to prove it. You have to ultimately see them execute, and that speaks to our view how you navigate in terms of this winners losers bucket.
And if you were, if you're an investor and you're looking at going beyond where the obvious winners would come from, you might have been wise enough, you might have been lucky enough to have pinpointed Intel and benefited from that 240% rise this year. SanDisk maybe, 560% rise. But it feels, and correct me if I'm wrong, it feels like those windows to kind of ride that wave have they gone? If someone hasn't ridden that wave, have they missed the opportunity?
But see, I don't think so, because the London cab driver is bearish on software. I mean, I could look at names like Datadog. If I was a week ago or 2 weeks ago, no one owned Datadog. Now look at it. There's Innodata, there's CrowdStrike, there's Palo Alto, there's Palantir. I mean, I think on software, look right now at Salesforce.com, ServiceNow, as just good examples. So it speaks to like what we were talking about, the derivatives. You have to continue to look out and understand who ultimately are the infrastructure players that are going to win. I could argue Microsoft, there's $100, $150 left that's not being factored in relative to, I think that's still viewed pretty negatively in terms of Microsoft. So I think those are the opportunities. A year ago, no one would own Alphabet. DOJ is going to break it up, AI is going to crush search. Now they have victory parties for Alphabet.
In which case, do you think Apple will come to regret its strategy of not investing to the same level in the hardware, the infrastructure, the data center build out, instead relying on this almost like pay-as-you-go licensing and relying on others?
I believe the table pounder in terms of large cap right now, right here, it's Apple. Because it's my view the consumer AI revolution is going to go through Cupertino. At WWDC, that's where they're going to start, the Gemini deal. Then eventually what's going to happen is all the models, whether it's US, Europe, Asia, they'll be on the phones. You'll have an AI-enabled device. You're going to have more and more apps. They're going to have a piece of that pie. They're essentially a toll collector on the AI consumer highway.
Why is OpenAI not going to be the toll collector? Because they're talking about coming up with a phone. Why isn't that this Nokia moment or Ericsson moment for Apple?
Because there's 1.5 billion reasons why that's not going to happen to OpenAI, because there's 1.5 billion iPhones. And it speaks to many, many people around the world, they view it as food, water, and their iPhone, maybe Netflix
so
as well.
So we're handcuffed to the ecosystem.
And that's the reality. No one has an ecosystem like Cupertino. It's about monetizing it. That's why it would never be the Nokia or sort of BlackBerry moment.
Right from the beginning of the interview, Dan Ives makes it very clear that recent earnings from big tech companies have strengthened his bullish thesis on artificial intelligence. In his mind, the numbers coming out of these companies are proving that AI demand is real, not hype, not speculation, and not just some temporary Wall Street narrative. He points to chip demand in Asia being 10 times greater than supply, and that alone tells you how intense this build-out has become globally. What I found really interesting is how he compares this current moment to the post-financial crisis era, when the FANG stocks completely dominated the market for years. That comparison is important because what he is suggesting is that AI may not just be another technology cycle. He believes it could become the defining investment theme of the next decade, similar to how mobile internet and cloud computing reshaped the market after 2008. And when he says he believes the Nasdaq could reach 30,000, that is obviously an extremely aggressive prediction, But what makes Dan Ives different from a lot of analysts is that he tends to focus more on long-term structural shifts rather than short-term valuation fears. Whether you agree with him or not, you can tell he believes this AI boom is not simply about Nvidia anymore. He thinks the entire technology ecosystem is about to transform around artificial intelligence. One thing I actually agree with him on is the idea that investors who only focus on Nvidia could eventually miss the broader opportunity. Nvidia has clearly become the centerpiece of the AI revolution, and later in the interview he literally calls Jensen Huang the godfather of AI. But Dan keeps emphasizing that the real money could spread far beyond just one company. He talks about what he calls second, third, and fourth derivative plays. Basically, he is saying that once the obvious winners become too crowded, investors start looking for the surrounding companies that benefit indirectly from AI growth. That includes memory chip makers, cybersecurity firms, software companies, cloud infrastructure providers, data center builders, and even power companies. That part of the interview was actually very important because it highlights something many retail investors overlook. AI is not just about chatbots and graphics cards. AI requires enormous infrastructure. Massive amounts of electricity, storage, networking, cybersecurity, and enterprise software are all needed to support this ecosystem. So when Dan mentions companies tied to energy infrastructure like GE Vernova, he is basically saying the AI boom extends beyond Silicon Valley into the real economy. And honestly, I think that is one of the smartest points he made in the interview. People forget that every AI query consumes computing power. Every AI-generated video, image, or large language model interaction requires data centers running non-stop. That means the demand for electricity and infrastructure could become one of the hidden stories of this AI era. Another major part of the conversation revolves around software companies and whether AI could actually destroy the traditional SaaS business model. This is a real fear in the market right now. Venture capital firms and investors are worried that many software companies could eventually become obsolete if AI can replicate their products cheaply or instantly. Dan Ives pushes back against that fear by arguing that investors need to separate companies with strong competitive moats from weaker players. He specifically mentions ServiceNow and Salesforce as companies he believes can successfully monetize AI rather than get disrupted by it. What he is essentially saying is that the winners in software will be the companies that integrate AI deeply into their platforms before competitors can catch up, and I actually think there is truth to that. A lot of weaker SaaS companies probably are vulnerable right now. If your product can be recreated by AI in 5 minutes, your moat may disappear very quickly. But companies with deep enterprise relationships, massive customer ecosystems, and mission-critical software probably have a better chance of surviving and thriving. Then he brings up Adobe, and this was fascinating because you can tell he thinks Adobe is under pressure. He basically says the company has its back against the wall and may need acquisitions or strategic shifts to stay competitive. That tells you something important about this AI cycle. Even dominant tech companies are not guaranteed winners. AI is moving so fast that companies which fail to adapt could lose relevance surprisingly quickly. One of the strongest themes throughout the interview is cybersecurity. Dan repeatedly mentions CrowdStrike and Palo Alto Networks as major beneficiaries of AI growth. His reasoning is pretty straightforward. As AI expands, cyber threats become more sophisticated, more automated, and more dangerous. That means companies protecting digital infrastructure become even more essential. And personally, I think cybersecurity could quietly become one of the biggest long-term AI winners. Every company rushing into AI will need protection against AI-driven attacks, data breaches, and infrastructure vulnerabilities. So while everyone is obsessed with AI chips, cybersecurity could end up being one of the most overlooked opportunities. Then the interview shifts heavily toward Nvidia, and this is where things get really interesting. Dan Ives completely doubles down on Nvidia's dominance. He basically says everything in AI starts with Nvidia because its chips are the heart and lungs of the entire ecosystem. And to be fair, looking at where we are right now, it is difficult to argue against that. But the interviewer raises a very important concern. If Nvidia is clearly the superior company, why are investors piling into weaker AI-related names like Intel at much higher valuations relative to growth prospects? This was probably one of the best moments in the interview because it exposed the psychology of this market. Dan agrees that Nvidia is still the better company, but he explains that investors are constantly searching for the next Nvidia. Once one stock becomes too obvious, money starts rotating into secondary names that could benefit from the same trend. That is why you see massive moves in companies like Intel, AMD, or smaller semiconductor and infrastructure plays. Investors are trying to identify the next layer of winners before the broader market fully catches on. Now personally, this is where I become a little more cautious than Dan Ives. I do think there is definitely some speculative froth building in certain AI-related stocks. Whenever investors start throwing money at anything remotely connected to a hot trend, you eventually get irrational valuations. We have seen this happen before in previous technology booms. But at the same time, I also think dismissing the entire AI trade as a bubble could be a mistake, because unlike some past speculative manias, these companies are generating real revenue growth right now. The demand is measurable, the infrastructure spending is real, and enterprise adoption is accelerating globally, so the challenge for investors is separating legitimate long-term winners from companies simply riding temporary hype. Dan also makes an interesting point about Palantir, which he calls a potential trillion-dollar market cap company within the next few years if execution continues. That is an extremely bold statement, but it also reflects how Wall Street is starting to view AI-enabled data analytics and government software platforms differently than before. For years, many investors dismissed Palantir. Now suddenly it has become one of the market's favorite AI stories. And honestly, this is something I have noticed repeatedly during this AI cycle. Stocks that were hated a year ago are suddenly becoming market darlings once investors realize they actually have a meaningful AI strategy. Dan even points out that Alphabet was heavily criticized not long ago because people feared AI would destroy Google search and regulators would break the company apart. Now, according to him, investors are practically throwing victory parties for Alphabet because AI integration has strengthened confidence in the company again. That really shows how quickly narratives can change on Wall Street. Then the conversation shifts toward Apple, and this part was extremely important because there is still major debate around whether Apple has fallen behind in AI. The interviewer questions whether Apple made a mistake by not investing as aggressively in AI infrastructure and data centers compared to companies like Microsoft, Google, and Amazon. But Dan Ives strongly disagrees with the criticism. He argues that Apple may actually become one of the biggest winners of the consumer AI revolution because of its ecosystem. His thesis is that AI eventually becomes integrated directly into the iPhone experience, turning Apple into what he calls a toll collector on the AI consumer highway. And honestly, I think this is one of the most underrated debates happening in tech right now. People focus so much on who builds the AI models, but distribution matters too. Apple controls over 1 billion active devices worldwide. That is an enormous advantage. Even if OpenAI creates incredible technology, Apple still controls the hardware ecosystem many consumers use daily. And history has shown that owning the platform often matters more than owning the application itself. The interviewer tries to challenge Dan by asking whether OpenAI could eventually create its own AI phone and disrupt Apple the same way the iPhone disrupted Nokia and BlackBerry years ago. But Dan completely dismisses that idea. His argument is simple. Apple's ecosystem is too deeply embedded into consumers' lives. He basically says people view the iPhone as essential as food and water. Obviously that is an exaggeration, but the broader point is clear. Apple's ecosystem lock-in remains incredibly powerful. And honestly, I think he may be right about that. Creating great AI technology is one thing. Replacing Apple's ecosystem is something entirely different. Apple has spent decades building hardware integration, app ecosystems, payment systems, services, developer networks, and customer loyalty. That is not easy to replicate overnight. Overall, this interview really captures the mentality driving the AI market right now. Dan Ives is essentially arguing that we are still very early in a transformational technology cycle that could reshape almost every sector of the economy. He believes the winners will not only include the obvious names like Nvidia and Microsoft, but also the surrounding infrastructure companies powering the AI ecosystem behind the scenes. Now, whether the market becomes overheated in the short term is another discussion entirely. There will absolutely be volatility, corrections, and probably some companies that fail badly despite all the hype. But the bigger message from Dan Ives is that AI is no longer just a speculative concept. It is becoming a foundational economic force. And if he is even partially right, then this AI race may still be in its opening chapters rather than its final innings. Now let's break down the 3 high-conviction growth stocks that sit right at the intersection of consumer behavior shifts, platform expansion, and long-duration compounding potential. Let's start with the first company. Warby Parker, ticker symbol WRBY, just reported first quarter results that, on the surface, look relatively modest. Revenue increased by 8.3% year over year, net income came in at $3.2 million, and the company now operates 337 stores across its network. For a casual observer, that reads like a steady but unremarkable retail update. But that interpretation misses what is actually happening underneath the surface. Warby Parker is no longer simply building an eyewear retail chain. it is actively transitioning into a vertically integrated vision care platform that combines retail, healthcare services, and emerging wearable technology into a single ecosystem. That distinction is critical because it fundamentally changes the long-term revenue model from transactional purchases into recurring, relationship-driven engagement. The core of this evolution is the company's push into holistic vision care. Today, most of its 337 stores are not just retail locations. They are functioning as full-service eye care hubs. Customers can walk in for comprehensive eye exams, update prescriptions, purchase glasses, and order contact lenses, all within a single connected system. This transforms each location from a point of sale into a recurring healthcare touchpoint. That shift matters because it changes customer behavior. Eye care is not a one-time purchase category, it is cyclical. People return annually for exams, they update prescriptions over time, and they often refresh eyewear as their needs change. Warby Parker is positioning itself directly inside that cycle. This is where the flywheel effect becomes visible in the financials. In the first quarter, average revenue per customer rose 6.9% year-over-year to $331. That metric is important because it shows that existing customers are not just buying once and leaving. They are spending more over time as they engage with multiple parts of the platform, from exams to glasses to contact lenses. What is forming here is a multi-layer customer relationship model. A customer might initially discover Warby Parker through affordable eyewear. Over time, that same customer returns for an eye exam, then orders contacts through the app, and later upgrades frames within the same ecosystem. Each step increases lifetime value while reducing reliance on constant new customer acquisition. From an investment perspective, this is one of the most important transitions a consumer company can make. Moving from episodic retail transactions to recurring service-driven engagement is what creates long-duration compounding potential. But the most forward-looking part of the story has not yet been fully priced into most models. Warby Parker is now entering the early stages of artificial intelligence-powered smart eyewear. Through a hardware partnership, the company is developing AI-enabled glasses that are expected to begin contributing revenue later in 2026. This is not just a product extension, it represents a potential category expansion into wearable computing tied directly to vision correction. What makes this particularly interesting is timing and infrastructure advantage. Smart eyewear is still an emerging category, and no dominant prescription-focused platform has been established yet. Most of the attention in this space is currently directed toward large technology companies developing augmented reality and AI-integrated devices. However, Warby Parker already has something those companies do not. It has a physical network of 337 retail locations combined with in-house optometry infrastructure and direct customer relationships centered around vision care. That physical footprint becomes strategically important if smart glasses require fitting, prescription integration, or in-person support. If the company can successfully establish early positioning in prescription smart eyewear before the category matures, it could gain a structural advantage that is difficult to replicate later. In other words, it would not just be selling glasses anymore, it would be embedded inside the next generation of personal computing for vision. On the financial side, what you are seeing today is still an early-stage scaling story. The company is balancing investment in store expansion, technology integration, and healthcare service rollout while gradually improving efficiency. The profit figure of $3.2 million shows that it is not yet operating at full maturity, but that is not the point of the current phase. The focus is on building density, increasing customer frequency, and expanding the value of each customer relationship. The real long-term question is whether Warby Parker can successfully evolve from a modern retail disruptor into a full-scale vision care and wearable technology platform. If it does, the current valuation framework may not fully reflect what the company could become over the next decade. But if execution slows or customer engagement fails to deepen across services, then it risks remaining a niche retail brand competing in a crowded consumer space. Right now, it sits in that critical middle stage where the story is no longer about potential alone, but about whether early signs of platform building can translate into durable long-term compounding. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move into the next company. Dutch Bros, ticker BROS, is one of those businesses that looks deceptively simple from the outside. It sells coffee, energy drinks, and smoothies through a drive-through focused model. But when you look deeper, what you actually see is a rapidly scaling consumer brand that is building one of the most aggressive unit expansion strategies in the entire fast casual beverage space. The first thing to understand about Dutch Brothers is that it is not trying to compete in the traditional coffee shop category on aesthetics or premium positioning. It is competing on speed, consistency, and emotional brand loyalty. The entire model is built around high-volume drive-through transactions, where the customer experience is designed to be fast, personalized, and highly repeatable. That repeatability is the core of the investment thesis. Dutch Brothers is essentially trying to turn beverage purchasing into a daily habit loop. Instead of positioning itself as a destination coffee experience, it positions itself as a convenient, high-energy, emotionally engaging stop that fits into a customer's everyday routine. That is why so much emphasis is placed on customer interaction, staff culture, and localized brand identity. What makes this even more powerful is the company's expansion strategy. Dutch Brothers is still in the early to mid stages of its national rollout, which means it has a long runway for store growth across the United States. Unlike saturated markets where expansion becomes increasingly expensive and competitive, Dutch Bros is still operating in a phase where new store openings can meaningfully contribute to top-line growth. Each new location is not just incremental revenue, it is a replication of a highly optimized operating model. Once a store reaches maturity, it can generate strong unit economics due to high transaction volume and relatively streamlined overhead compared to traditional sit-down coffee shops. The key metric investors tend to focus on here is same-shop sales growth combined with total store expansion. When both are moving in the right direction, you get a powerful compounding effect, where existing stores improve profitability, while new stores accelerate total revenue growth at the same time. Another important element of the Dutch Bros model is its brand positioning with younger consumers. The company has built a strong emotional connection with Gen Z and younger millennial demographics, which is extremely valuable in the beverage industry. These habits tend to form early and can persist for years if not decades. This is where Dutch Bros starts to look less like a coffee chain and more like a lifestyle brand with retail infrastructure. The more frequently customers engage with the brand, the more embedded it becomes in daily routines and the more resilient it becomes against price competition. Financially, the company is still in a high-growth expansion phase. Revenue has been scaling as new stores come online, and the focus remains heavily on disciplined expansion rather than overextending into unprofitable territories. The business model relies on maintaining strong unit economics while scaling store count aggressively enough to capture national market share over time. One of the most important long-term variables here is whether Dutch Bros can maintain consistency in store performance as it expands into new regions. Many fast-growing consumer chains struggle when they move beyond their core geographic base because brand strength and operational execution can vary across markets. If Dutch Bros can maintain its culture and efficiency at scale, the upside becomes significantly larger than most traditional beverage chains. But there is also a real execution risk embedded in the story. Expansion-driven models can break down if new stores underperform or if competition intensifies in key markets. The difference between a compounding growth story and a stalled expansion story often comes down to how well the company manages quality control while scaling rapidly. What makes Dutch Bros interesting in the current market environment is that it represents a pure play on consumer frequency. It is not dependent on a single product innovation cycle or technological disruption. Instead, it is focused on one thing: increasing how often customers choose its brand over alternatives in their daily routine. And if that frequency continues to increase while the store base expands, you get a compounding revenue engine that is driven by both footprint growth and behavioral loyalty. This is why investors are watching closely not just the headline growth numbers, but the underlying consistency of store performance across its expanding network. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move into the third and final company. Cava Group, ticker symbol CAVA, represents one of the most interesting consumer growth stories in the entire fast casual restaurant space right now. At a surface level, it is a Mediterranean-inspired restaurant chain, but at a deeper level, it is building a highly scalable, high-frequency dining concept that is designed to compete in the same behavioral category as other fast casual leaders, while carving out its own differentiated positioning. What makes Cava compelling is not just the food category it operates in, but the way it is structured as a modern restaurant growth platform. It combines menu simplicity, operational efficiency, and strong brand identity into a system that can be replicated across markets without losing consistency. The core of Cava's strategy is standardization with customization. Customers choose from a streamlined set of bases, proteins, toppings, and sauces, which allows for personalization while keeping kitchen operations efficient. This model is critical because it allows the company to maintain speed of service and cost control while still offering the perception of variety. That balance is one of the most important factors in scaling fast casual restaurants. Too much complexity destroys efficiency. Too little customization reduces customer engagement. Cava sits in a relatively strong middle ground where it can deliver both consistency and personalization. The company's growth story is being driven primarily by aggressive unit expansion combined with strong same-store performance. Each new restaurant is designed to replicate a proven operating model, which allows revenue to scale alongside footprint expansion. As more locations open across the United States, the brand becomes more familiar, which in turn drives higher traffic and repeat visits. Another important element of the Cava thesis is brand positioning. The company is not competing directly with traditional fast food in a low-price race. Instead, it is positioned in the fast casual premium segment, where customers are willing to pay slightly more for perceived quality, freshness, and customization. This positioning is important because it supports healthier margins and stronger customer loyalty. In many cases, fast casual brands that successfully establish a strong identity are able to maintain pricing power even in more competitive environments, simply because they are not purely commoditized offerings. From a financial perspective, Cava is still in a growth-heavy phase. Revenue has been expanding rapidly as new restaurants open and existing locations mature. The company is prioritizing expansion over short-term margin optimization, which is typical for businesses in early scaling cycles. What investors are watching closely is whether new store economics remain consistent as the company expands into new geographies. Early-stage restaurant chains often perform extremely well in core markets but face challenges when they expand too quickly or into less familiar regions. Maintaining operational consistency across a growing footprint is one of the most important execution risks. At the same time, there is a powerful tailwind supporting the broader category. Consumer preferences have been shifting toward fresher, more customizable, and perceived healthier fast casual options. Cava sits directly inside that trend, which gives it structural demand support beyond just brand strength. Another key point is unit economics. If each restaurant continues to generate strong returns on invested capital after maturity, then every new location becomes a compounding engine rather than just incremental growth. That is what separates temporary growth stories from long-term scalable platforms. But it is important to remain balanced here. Restaurant expansion stories are inherently execution sensitive. Labor costs, ingredient inflation, competitive saturation, and consumer spending cycles can all impact performance. The companies that win long-term are typically the ones that can maintain consistency in both food quality and operational efficiency while scaling aggressively. Cava's opportunity is significant, but so is the challenge. It is trying to expand quickly while preserving brand integrity, customer experience, and unit profitability. That combination is difficult to execute at scale, but if done correctly, it can create a durable national brand with long-term compounding potential. When you step back and look at all three companies in this video, the common theme is clear. They are all in expansion phases where the real story is not just current financial results, but the trajectory of their business models over time. Warby Parker is evolving from retail into vision care infrastructure and wearable technology. Dutch Bros is building a high-frequency consumer habit machine through aggressive store expansion. Cava is scaling a modern fast casual dining platform designed for repeatable national rollout. None of these stories are about immediate perfection. They are about whether execution can stay ahead of scale. When you compare these three businesses, the key question becomes this: which of these companies do you believe has the strongest long-term compounding advantage through scale, brand power, and unit economics over the next decade? If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Drop your thoughts in the comments because I want to see how you are thinking about these different growth models and which one you believe has the most durable runway. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.